All right, today we're going to tear into a really fascinating technical analysis on a stock called IREN. It is a classic case of just completely conflicting signals, a real head-scratcher, and our job is to figure out what it all means. So let's just dive right in.
So check this out. IREN's stock price just exploded, going from around $15 in June to nearly $50 by September. That is a monster gain in, just a few months. And this incredible climb is what sets up the whole puzzle we're looking at today.
Because you'd think after that kind of run, the final call from this deep analysis would be screaming, strong buy, right? But it's not. It's neutral. How in the world does that happen? A stock goes up almost 250%, and the signal is basically a shrug. That is the big question we are going to unpack.
Okay, so to figure this out, we gotta put on our detective hats. First up, let's look at all the evidence that's shouting, this thing is a rocket ship. We're gonna build the case for the bulls, and trust me, it's a powerful one.
But before we get to the numbers, just a quick sidebar. When you hear analysts talk about trend strength, they're asking a simple question. How much power is behind this move? Is this a gentle uphill drift, or is it a full-blown hurricane pushing the price higher?
And here's our first piece of evidence. Look at that number, 58.6. That's the score from what's called the ADX indicator. Now for context, anything over 25 is considered a strong trend. IREN isn't just strong, it's more than double that. This is like a 5-alarm fire bell telling us the upward momentum is just incredibly powerful.
And for the bulls, it gets even better. Think about it like this. Imagine 14 different safety nets at different levels, representing the stock's average price over days, weeks, and months. Well, the current price is floating above every single one of them. That is an overwhelmingly positive sign that this uptrend is solid as a rock.
And the evidence just keeps piling up. The IREN indicator, it's basically screaming uptrend. The MACD confirms all that positive momentum. And maybe most importantly, the volume indicators are telling us that people are actively buying the stock up and holding on to it. I mean, it is a textbook, picture-perfect bullish setup.
So, if everything looks so perfect, you're probably asking, where on earth does a neutral rating come from? Well, this is where our detective story takes a sharp turn. Because while the engine is clearly running at full power, a bunch of gauges on the dashboard are flashing bright red, warning that this thing might be seriously overheating.
And this slide right here. This is the whole conflict in a nutshell. It's a tug of war. On one side, you've got these momentum indicators like the MACD just screaming, go, go, go. But on the other side, you've got a completely different set of tools like the RSI and stochastics, and they're waving their arms, shouting, whoa, hold on, let's slow down a bit.
You hear this term overbought all the time, but what does it really mean? This is the perfect way to think about it. It just means the price has gone up too far, too fast. The move has been so aggressive that it's left the stock vulnerable. That sprinter is exhausted and probably needs to take a break or maybe even take a step back before they can run again.
And these aren't just feelings. We've got hard numbers. The RSI is knocking on the door of that 70 warning level. The money flow index is already past it. And the stochastic indicator, it's way up at 85.5, deep in what we'd call the red zone. Now, this doesn't guarantee a crash, but these are serious warning signs that the rocket might be running out of fuel.
Okay, so you've got this epic battle, incredible momentum versus some really serious warning signs. So what's an analyst to do? Well, you map out the battlefield. You identify the key price levels where the fight between the buyers and the sellers is going to be the most intense. And we call these levels support and resistance. So let's make this super simple. Just think of a ceiling and a floor. The analysis points to a ceiling right around $48. That's a spot where sellers are likely to show up in force. And then there's a floor down near $35, and that's where buyers are probably waiting to jump in. That's our playing field right there.
And here's the absolute kicker. Where's the stock right now? At about $42, it's trading smack dab in the middle of that battlefield. It's in no man's land. It's not testing the ceiling, it's not testing the floor, it's just kind of stuck in the middle, which perfectly captures the total confusion we're seeing in all the different signals.
So since the stock is caught between these really powerful arguments for going up or down, a smart analysis doesn't try to be a fortune teller. Instead, it does the next best thing. It lays out the 3 most likely scenarios based on all the evidence we just went through.
So here are the 3 ways this could play out. First, the bull scenario. That super strong trend just overpowers everything and the stock smashes right through that $48 ceiling. Second, the neutral path. The bulls and bears just fight to a draw and the stock chops around sideways for a while just catching its breath. And third, the bear scenario.
Those overbought warnings were right on the money, the engine sputters, and the price falls all the way down to test that $35 floor. And that, right there, brings us full circle. That is why the final signal is neutral. It's because, honestly, you can make a compelling case for all three of those scenarios. The bullish evidence supports path 1, the warning lights support path 3, and the stock's current price supports path 2. The evidence is just way too contradictory to make a high-confidence call in any one direction.
So, what's the big takeaway from all of this? I think it's this. This kind of analysis isn't about giving you a crystal ball to predict the future. It's about acting like a weather forecaster, weighing all the data to understand the probabilities. It helps you see where the potential storms are, so you can manage your risk and make a much more informed decision.
And that really leaves us with the million-dollar question, doesn't it? In the real world, you rarely get a perfectly clear signal. You're almost always faced with conflicting evidence. So when the data is pointing in two different directions, when you have a powerful case for the bulls and an equally compelling case for the bears, how do you decide what to do next?